Okay, we're going to kick off with our investors panel, Strategies for an Emerging Bull Market. We've titled it here. It's basically an opportunity for us to sort of set the scene, see where we are in the mining cycle, and get the views of a range of investors. And delighted to welcome to the stage Stefan Eitel, who is the Director of Metals and Mining at KfW IPEX Bank. He's flown over all the way from Germany for this event and also to go on to Perth, but delighted to have you here today, Stefan. We have Jeff McNamara, partner at Medea Capital Partners and also very heavily involved in the Singapore Mining Club. John Hodder, who's a principal at Tembo Capital down in Australia. And Robert Adair, who's Director International Equities at UOB Asset Management in the building just next door. So, gentlemen, if you'd like to take the stage. A quick round of applause for our panelists. Welcome them to the stage. We've got some microphones there. Now, as I'm going to be asking them some questions. They're going to be sort of interjecting here and there. If you have something that you'd like to add or a question you'd like to ask, please just raise your hand and we'll have a microphone come over to you. Don't be shy. This is a chance for everybody to share their views. So, please feel free to stick your hand up whenever you like. I'll also ask the audience for some questions, so don't leave me hanging, as they say. So, welcome, chaps. We're going to sort of just, set the scene. Where are we in the mining cycle? What are your thoughts on, in 2016, obviously, people were feeling pretty positive. Mining equities were going up, possibly slightly leveled off at the start of this year with, fear of a trade war possibly between America and China. But what's the mood at the moment? Robert, you've just lifted a glass, so it's probably should we start with you?
Okay, thank you. Good morning, everyone. I think just so from two perspectives, just the macroeconomic and where we are in the broader market, and then from a sector-specific basis. I think there's a macroeconomic. There's a bit of a conflict going on at the moment. If you read half of the major broker reports at the moment, it's buy cyclicals and get out of defensives, and the other half are saying it's time to get out of cyclicals and go into defensives. So that there's a mixed picture there. It's certainly been the right thing to have been in the cyclicals. And personally, I think that's going to continue for a little bit longer. We might be late cycle, but it's still, there's still possibly a year or two of good growth to come. And then on the sector-specific basis, I think that, the single most important point is the CapEx cycle. The last cycle peaked in 2011. The CapEx numbers have been coming down every year since then. They probably bottomed in 2017, but the upturn has been slow. So that means that reserve lives have fallen. The investment that's being made is, if it is being made, it's in brownfield projects. It's not in large greenfield projects. And I think, so structurally from a supply-demand perspective, I think we're in a good place, and it's an encouraging time to invest.
And when you describe cyclicals versus defensives, in terms of metals, the different commodities, which ones would you put into the cyclicals bag and which ones into the defensive?
I think I'd just put all mining stuff into cyclicals. I don't think the generalist fund manager is really that particular about the different types of commodity. Obviously, when you're looking at the different base metals or bulk metals, they've all got a different supply-demand status. So some of them, like zinc, have been in short supply, although that looks like it's turning around now. I think I'm actually quite positive on the base metals. I think everyone's been talking about copper as when is it going to start being structurally short? I think we're very close. It's been something that's been talked about for years, but I think we're finally reaching the point. And with the impact of electric vehicles, I think you have to look at a lot of these so-called new energy materials, including nickel.
And your UOB, what sort of type of company do you typically invest in? Is it the majors? To what extent do you look at the juniors?
Pretty much everything. The problem with going sub 200 million market cap is simply liquidity. So the risk department in our company will flag anything that we can't exit out of in, say, 8 trading days. So simply by that definition, you tend to be limited to stocks that are above 200. But you know, there are exceptions. I mean, there are things that are smaller that have very good liquidity, so it's not a hard and fast rule.
Okay. Stefan, let's move over to you. First of all, KfW IPEX. Do you want to give us a little background to what you do?
Sure, my pleasure. Good morning, everybody. KfW IPEX Bank is the commercial arm of the Germany state-owned KfW Bank, founded after the Second World War to reconstruct the German economy. And we, on the IPEX level, again, we are a commercial bank and have the political mandate to support projects, in particular mining projects, with any German and European link into it. German-European link means either equipment-based projects with equipment supplies going into mining projects, or European off-takers being involved, or European investors being involved. So that's kind of our the strategy we are following. We do mining for 60 years now in a row, all through all cycles. And what we are seeing today, and I agree with Robert, the low capex kind of bottomed out in 2017, and I mean, the industry has ever been cyclical, and we clearly see the next wave of projects, but we're actually seeing 2 different waves. The one is the more traditional one, with the base metals, with the industrial metals, and copper to name. First of all, particularly in the projects we are following, particularly happening in the Americas, South and North America. But also, at the same time, and for the first time, another wave, which is kind of these new age minerals, these battery materials of all sorts. And there we see, with a specific focus on the European names, just for example, to name the European car makers, still looking for their right strategy to source those materials, and also to the classical make or buy decision, to what point in the value chain they are going, what they are buying, what they actually manufacture from themselves. That's an interesting discussion we have in Europe, and to see and to discuss the strategy with the potential off-takers.
And typically, how does KfW IPEX, what sort of size of deal do you do, and what stage of development do you get involved in a company?
As a classical bank, we are only in debt financing, so we are entering into projects after a BFS, DFS. Yeah, pure debt, and other than that, we are basically open to any type of project. Can be juniors, can be mid-tiers, can be majors, where bank money is questioned.
And you're in sort of investment, do you have an investment committee or someone looking at it? And what's their sort of appetite for risk at the moment? Is they you know, compared with, say, last year, are you loosening the purse strings or right now, or how's it looking?
Well, as a bank, in general, and that relates to all banks, we are seeing increased competition to non-banks, near banks, out for financing mining projects. So as a bank, you need to show more risk appetite maybe before in order to stay in the market. So the traditional easy projects in easy jurisdiction with easy metals are increasingly taken away from non-banks. So you need to be open for niche markets, for opaque markets, for less transparent markets, and to stay in the business. And I think we have that openness, we have that risk appetite. Again, we are in the industry for 60 years. We know the fundamentals and the metrics, and we at least we believe to know how to deal with mining risks.
But the projects you invest in, do they typically have to have a sort of a German industrial company as the kind of ultimate end user? Is that the aim? Or
That's one of them. It's, first of all, we don't have a German focus. It's a European focus. And again, can be European off-takers, can be equipment suppliers, can be investors, anything European in projects, more than the German shepherd.
Fantastic. Jeff, what are your views on the cycle? So, Medea, tell us a little. Medea, tell us about Medea.
Hi, Toby. Thank you. Good to be here, and morning to all. So Medea manages several pools of capital. One pool of capital is a family office that's investing in forestry. Another pool of capital is another family office that's probably is in the mining space, but I suppose that's more in the battery thematic. So that family holds some royalties and material positions in some junior companies. And we have a modest amount of our own capital. We've seeded two Australian companies with assets in Chile. One has 2 gold assets and the other has a copper cobalt asset. We'll bring those to market within the next 12 months, probably on the ASX. And we've done a restructured, I suppose, a couple of companies that are on the Canadian exchange. A broad description would be they had lazy balance sheets and need to be refreshed. That may include management needing to be refreshed. So we've put some of our capital into those businesses as well. From an industry perspective, I think it's quite an interesting dynamic. If I sort of look at it geographically, whereas I look at the ASX bourse, certainly that there's a lot of capital there, high risk capital going into the battery thematic. I think some of that's now trickling into gold and the base metals. I see the battery thematic has legs for the short to medium term. As always with mining, the demand will be met with supply, and then eventually the supply will probably overtake demand, and there'll be a correction. But then if you go to North America and I think Europe, typically TSXV and AIM, the higher risk capital, certainly in the Americas, has been more focused on cryptocurrencies and marijuana. So I think a lot of that capital that historically has gone into mining and exploration has yet, I'm presuming it's going to come across, and I suspect it will, but it hasn't at this juncture. I think we've seen probably a shift away from the cryptocurrencies more to marijuana at the moment. Hopefully people make money and then decide to bring that across to the resources space. And I think the London Europe market is a little similar. There's a lot, I suppose, a more broader range of opportunities to invest there than say Australia. And I still think in London, there's money there for projects that are going into production and generating cash flow, but we haven't really seen that trickle down into many explorers yet. But I think to Robert's point, I think the copper thematic looks very strong. Fundamentally within the base and precious metals, there still haven't been many discoveries, and there's still not a lot of capital going into that space, those two spaces. So, I think we've already started to see, certainly in Australia, M&A activity in the gold space. And we're going to see more of that moving forward. So I think we're certainly off the bottom, and I think it's a pretty exciting time to be looking at the space and to be deploying capital into it.
You mentioned that you have work for a family office that has invested into the battery space. Is batteries something that has sort of captured the imagination of Singapore? Singapore obviously famed as a sort of tech hub. To a certain extent.
Yeah, look, I think it is. I think there's a real opportunity for the companies in the battery space to raise capital out of Singapore. I think there's a lot of capital sitting here that wants to play in that space, but probably doesn't know how to do it. there's certainly a lot of interest about that. And you know, Scott Clements is here from Canaccord. Canaccord hosted an event along with the Singapore Mining Club a couple of years ago that was very well attended, you know, around the battery thematic. So I think that is a space. It's of a lot of interest to, you know, the Singaporean market. And I think the other one's gold, which always has been, and to a lesser extent, you know, precious stones, diamonds. They're probably the three commodities in my mind where, you know, there's a real desire for, you know, whether it be more on the retail or the institutional level, you know, money out of Singapore to find, you know, the right investment opportunities for them. So I think that's a real opportunity for the companies that are in those spaces to try and tap into that capital.
Right. John, let's move over to you. Let's start us off with a very brief intro to Tembo, and then your thoughts on the market.
Okay, well, hello. Yeah, thank you very much for the invitation to attend, and welcome to everyone here. Just very briefly on Tembo, we're a private equity, basically 300 million under 2 funds. We've probably made now 12, 13 investments. So we've been very active since 2014. We predominantly look at the junior to intermediate space, and we'll look at everything from early exploration through to production. Where are we on the cycle, though? Well, it's a little bit different for private equity, but I was a fund manager for a while, for 6 or 7 years, and so I'll give you my view as opposed to, say, a Tembo view. The market probably peaked, globally in mining around 2.2 trillion, 2012, got pretty much hammered down to 700, 750. 2.2, yeah. It probably bottomed at the Glencore recapitalisation, early 2016. And since then, we've probably come back to about 1.5. So we've had a reasonable recovery, but we're still, you know, 30, 40% off the peak that we saw. And a lot of the commodity prices are touching those sort of numbers more in the bulks. And copper, for example, not going crazy, but you haven't seen the crazy response that you did see in the market in that 2005 post, even excluding the GFC, that period. So even though we're a Guernsey-based, London-based fund, I'm in Australia and I'm in coal country in Queensland, and I can remember when hard coking coal went over $200, man. You couldn't not get people buying coal companies. Now, it's the junior market, yeah, sure, they've bounced, but it's much more subdued. And you'll see that in the major end of town. They're really struggling to, in my view, get off the five times EBITDA type numbers of valuation. So it seems to be that the market just doesn't believe it's going to be stronger for longer. They're struggling, and for the generalists in the cycle, it's not an easy industry to understand. Lead times are long, and as we've heard from Robert, what's more interesting is looking at the CapEx cycle. And I think this cycle, there's a reasonable amount of intrepidation. I think we're actually in a very good space to continue. But one of the reasons why is that actual CapEx cycle, because what we've seen in the last 5 years as demand has finally caught up with some of the commodities that were in oversupply, the majors have had it constantly told to them it's time to repatriate dividends. It's not, you know, the average fund investor at that top end of town hasn't quite got through a view on global growth, and yet this year we're probably seeing synchronised global growth for the first time since the GFC, and people are starting to question in certain commodities, you know, and the obvious one that everyone hears about is copper, but it is a good one because Dr. Copper covers a lot. You know, where are the next big copper projects going to come from? So, you know, from a private equity perspective, you know, we're very long copper in our second fund because, you know, we see that thematic, and we really see us hopefully growing the opportunities that the majors then just come and acquire. as part of their growth. Now, not every investment thesis is based that way, but that is a good way of looking at it. So where do I see the cycle right now? I feel that, you know, as it's already been said, the seed money that used to come into this sector has been very specific in the last few years. It's really chased EVs, or in Canada it hasn't been chasing the sector at all. So it has still been difficult for a lot of junior explorers to find that funding, but that certainly has started to loosen up in the last 12, 15 months. We're seeing the street far more active than we were in that 2014 to 2017 period where, they were really struggling to raise money.
In general, how long do these cycles last from being at the bottom of the market to being sort of champagne corks flying?
Depends on your view on different commodities and cycles, but generally the industry, a good cycle's 2 years, but up until the last cycle it was quite a, as they called it, a super cycle, but generally from peak to trough, I don't know, 4 years. That wouldn't be a bad number. Other people have a different view, but I think we are all cyclicals, right? But the interesting thing to me is if history just repeats, the most valuable people, as you know, are librarians. Each cycle is slightly different, and what I think we're seeing in this cycle, and this is my view, is a lot of the commodities have moved often more on China policy of environmental. So. Coal was dead until China woke up one day and said you can only do so many days mining X, Y, Z. And I think the fund managers, the big global fund managers, are saying, well, what one hand can take, the other can take away quite quickly. It's hard to see that was a demand-driven event. It was more curtailing an oversupplied market. And so, maybe this is the problem that, a lot of the people who, they're just not certain that the next leg is here to accelerate. And I think it is because of fundamental capital, the constraints and the new investment in new projects. And as you know, it's a renewable industry, so these mines all have very limited time. So it's not like the capital has to come at some stage.
Robert, you were going to...
No, I just remember a very good report that Citi put out a few years ago. That their view on the cycle was it was about a 7-year, and the up leg was 4+, and the down leg was shorter. But then you had the super cycle, which it was longer. It was instead of 7 years, it was 9 years. So then things got slightly out of whack. But it is a positive, because if you are talking about a regular cycle, and that was a sort of post World War II up until the super cycle, then if the cycle bottomed in 16, 17, it means that we should be due for relatively good conditions. And then it goes back to the macroeconomics. So people at the moment are saying, is this a repeat of sort of 2011-12, where the market rolls over quite sharply, or is it a sort of muddle through period, 2004, 5, 6, where things held up and the market was okay, and at the moment it looks like it's more of a muddle through. So was it China M2 money growth is 8%, industrial production is still 7%. I mean, everything's rolled over from quite elevated levels, but it's still at very healthy levels. So
and when we talk about a cycle, should we be talking about, it's not just one cycle, there are multiple levels in that, aren't there? So you've got coal at one end, which is obviously recovering recently because of China's controls, production controls, but then you've got the battery materials at the other end, or copper at the other end, who have genuine, copper has genuine demand supply reasons for its current high price. So
yeah, and sorry. I mean, if you look at the EVs, it's very, very difficult for myself, geological background and things like that, and been in the industry all my career, to tell you which battery is going to win the battery race. Everyone tells me their batteries is the battery that's going to win the battery race. But if you take the second derivative, if you believe the EV story, and it's really just a case of how quickly you think these cars and other things are going to be put into the market. Either way, it's an incredibly bullish story for copper. It's quite a bullish story for nickel. You don't actually have to play the lithium graphite, and it's very hard for us on PE to see how we get out of those, as opposed to if we find a good copper deposit, we know how we're going to get out of that. But that isn't to say that, you know, so you're right, we have these sort of subcurrent cycles, and we've always had them in mining, you know, and they go down to different speculative commodities that are quite thin. You know, it was rare earths back in 2007, you know, but you could only get 2 companies that had rare earths. So, I mean, there was always these little cycles within cycles, but it's what attracts people to come to the market, and that's returns. And that's really what I'm saying is where we're seeing the returns over the last few years. But anyway, that's my view. So.
Yeah, I think what people tend to miss on the last, or you know, the super cycle, or you know, I'd just say the last cycle, right, was the fact that LNG had a big part to play in that. So there was actually a big component of construction in that cycle. Certainly, you saw that in Australia. You know, there were other LNG projects built globally, and that sort of added another leg to the cycle, in my mind. If you look at LNG at the moment, you're actually now starting to see you know, that excess LNG being taken up. Prices have come off a bit, but that most of that product's still going into the market and being sold. You know, and if you use Perth as an example, right, you went and stayed in hotels that were basically built in 1960s, 1970s, had never been renovated, and you were paying $600 a night, right? And a lot of that was driven by, you know, Chevron, Shell, all these big companies bringing people in from all over the world, and them transferring to these offshore projects. So I think for the current cycle, you're probably going to see another leg potentially come from LNG. You know, there will, over the next 5 to 10 years, be more LNG projects built and expansions to meet that demand. And yeah, I you know, as John said, the battery thematic is, you know, is another potential leg again. You know, copper, there's a lot more copper used in, you know, whether it be the infrastructure for the electricity, for electric cars and everything else, and cars, than any other commodity. So it's very positive for copper. I mean, when you look at the prices pretty much across the board for commodities are good. Yeah, there's certainly some that look a bit heated, but still the supply-demand fundamentals are strong. So I think, yeah, we're in a very good position in the cycle. And everyone has different risk appetite. So, you know, how do you play that cycle? What's your comfort zone? You know, typically these cycles are somewhere, in my mind, between 4 and 7 years. You know, I think the whole battery thematic, the technology space, has the potential to have a greater influence than it has previously. You know, I have no idea how that's going to play out, but.
Well, Stefan, do you have any sort of figures on, or ballpark figures on sort of the European EVs and also renewables, which obviously is also very copper intensive?
Yeah, first of all, on the cycles, I believe history doesn't repeat itself. So a former cycle is not necessarily a blueprint for the next cycle. If you look at one more traditional, like copper, it appears to be on first glance that this kind of boom now is resembling the last one. Kind of started last year, easily takes us through this year and next year, and by 2020 we'll see whether it's going to start to taper off already. On first glance. On second glance, if you look at copper, only looking at the traditional uses like construction and electric infrastructure, that's the one thing that rather speaks for a traditional cycle. But if you look the use of copper into EV, an electric car takes about 4 to 5 times as much copper as a combustion engine. So this kind of rectifies its own cycle in a way. And then there are all those kind of new age minerals and materials which probably rectify their own cycle. with the big question, which kind of technology will survive? Nobody knows which kind of battery technology will survive, if any. Maybe we end up with hydrogen cells and you don't have batteries at all.
But
I mean, who knows? I mean, but this kind of new age minerals, there's a lot about Europe. Of course, a lot about China as well, as usual, but a lot about Europe as well, with the dominant car makers in Europe. And in our reading and from our discussions and meetings with them on the corporate level, they're still looking for their strategy. They have not decided how to source. As I mentioned before, the classical make or buy decision. Where are they on the value chain? The battery itself is clearly considered to be key and key component. They will certainly manufacture the battery, because that's tailor-made to the specific car anyway. But how about the cells? The cells going into the batteries. By today, they buy it from China, from Korea, from the obvious suppliers. But if they really materialize on their strategy, having 1/3 of EV cars, or one third of cars being EV within the next 10 years or so, it's not going to work. Those traditional value chains certainly not going to work. So they need to define their strategy, how to really safely secure the flow of whatever, the raw material or any intermediate product, the cells or whatever. And our reading is they're employing a lot of people in that currently and have a lot of discussion in internal working groups. In my reading, here and there you see some press releases like BMW securing cobalt, but if you look deeper, there is nothing behind. That's just a press release.
But do they need to get on with it, don't they? Because the Chinese are, all the Asian economies are getting on with it, and America is building these gigafactories.
Sure.
Are we going to see gigafactories being built in Europe?
There's some plans. One is in Poland, to my knowledge. There's a large Volkswagen is building a large pilot plant in Germany. They're investing 3 million digit numbers. But that's a pilot plant. It's not the final strategy.
But when we talk about, people often talk about the different battery makeups and the fact that we don't know what the battery is going to be in the future. But these lithium batteries we've got today, they started their development sort of life cycle sort of 30 years ago, and it would take another 30 years to really, this is the batteries we've got now are the batteries that people are going to be using for this sort of rollout of EVs. So the Europeans need to get a wriggle on, aren't they? Otherwise they're going to, you cannot take cobalt out of a battery at the moment. They're looking to reduce it to the 811 formula, but you can't take it out right now. So there is going to be a massive scramble, isn't there?
Yeah, the reality is at the moment the lithium battery is the battery that's going to last for the next couple of decades, right? The car manufacturers have committed to lithium. Yes, there's no doubt there's new technology coming, but that's going to take time, and then it's got to be taken up on a large scale. That will come, I suppose. The great thing about technology is the uptake of these things and how quickly they develop. They do it exponentially. So, certainly there will be other sources of metals that will come in and either replace or, a battery that will completely replace lithium. But I suppose, certainly in the medium term, you've seen most of the European and certainly all the Asian car manufacturers commit to the lithium battery. The US, outside of Tesla, I think, has been pretty slow to get on board. So, whether that dynamic, Ford was in the FT a couple of days ago. They're really struggling, right? And they still don't have appeared to have really embraced the electric car. And I think that's probably generally for the US car manufacturers. So, is that going to have an impact going forward? At some point, you expect they're going to have to embrace that technology and move in that direction.
Do you have any questions from the audience or comments from the audience, from our panelists here? You've only got a small amount of time left, but if you have a question. No takers? Okay. Well, you've all painted a reasonably rosy picture, I think, of the market, particularly around copper. John, you mentioned China, and you said that although it's, the controls are obviously policy driven, and there is a fear that that they may change that policy and take it back. But I think my take on that was that the reason they've done it is because of the air pollution problems, and you've got people now in power in China who now have grandchildren, and they're worried about them growing up in Beijing or whatever with this dust in the air. So is it likely? What's the likelihood of them saying, actually, we're gonna ramp domestic production back up?
I feel you may have misinterpreted the comment. When the Chinese say they do something, they tend to do it.
Yeah.
All I'm saying is the psychology on the market
Yeah.
is that some of these commodities weren't necessarily very supply constrained. The prices weren't moving because fundamental supply wasn't keeping up with demand, like what we're seeing in a lot of the battery mineral stuff. So there's huge demand now for cobalt, lithium and stuff. Prices have moved. Market will rebalance itself. All I'm trying to give you is a psychological understanding of why people, to me, Rio and some of these still look like they're very cheap on forward multiples, if you have my view. But the market's circumspect for several reasons, I think. One, they've blown capital up in the past, and, it was only yesterday in a lot of fund managers' views, So, we can't keep going about the sins of the past, but it will take a while. But yeah, so, like, my view on China is that, that they're one of the more stable. When they say they're actually going to do something, you can pretty much put it in the bank, they're going to do it.
Absolutely.
So, yeah.
So you're saying that basically across we sort of run out of time here, but basically when it comes to sort of copper and the battery materials, that's all looking pretty bullish, pretty positive. And when it comes to things like the bulks such as coal, the fund managers are actually being a bit slow on the opportunity there. So for the rest of us, we ought to get in.
No, I don't know if you're being slow, or the market's just not believing the stronger for longer view on some of the bulks. And I mean, if you want to know what we, we've had a very, our last investment from the fund was, for example, in uranium. I mean, we fund, nobody talked about uranium at all, and in Indaba, we kind of fundamentally like an industry where everybody's shutting down mines. Something's going to have to give in that space. So, these are cycles, and I suppose all I'm emphasising is that each commodity has internally its own cycle. So, but I do believe, as a group, as a cyclical industry, because every commodity is cyclical, it still looks like there's a few very good years in front of us.
Fantastic.
Okay.
Well, thank you very much to our panelists. A round of applause for.